Okay, let's dive right in. For every single buyer in the stock market, there has to be a seller. It's the most basic rule there is. But what happens when one group of buyers gets so huge, so relentless, that you start to wonder who on earth could possibly be left to sell to them?
This is the huge mystery we're exploring today. The tidal wave of money pouring into passive index funds is, without a doubt, one of the biggest forces shaping modern finance. And it creates this massive puzzle, with billions flowing in, constantly buying. Who is taking the other side of that trade? We're going to unpack some incredible new research that finally cracks this case. And I'll tell you right now, the answer is not what you think.
And we're not talking about a small trend here. I mean, look at this chart. The scale is just staggering. In about 20 years, passive ownership has shot up nearly tenfold. That represents a constant, mechanical, almost unstoppable demand for stocks. A huge wave of buying that absolutely must find a seller. So let's start where the researchers did, by rounding up the usual suspects, right? The common wisdom has always been that as people plow money into passive funds, they must be pulling it out of active funds. So it just makes sense that active managers would be the ones selling their shares.
But this is where that common wisdom gets completely blown out of the water. The researchers calculated what they call a beta for each investor group. Just think of it as a reaction score. Negative means they sell when index funds buy. Positive means they actually buy too. And get this, active funds have a positive beta. They aren't selling to index funds at all. They're out there buying right alongside them.
This just completely flips the script. We all thought we were just watching a simple shift, money moving from one pocket, active, to another, passive. But the data shows something way weirder is going on. Instead of soaking up the demand from index funds, these other big investors are actually trading in the same direction. They're making the problem worse, which just deepens the mystery of who is actually supplying all these shares.
So if it's not the other big funds, then who is it? Well, the data points to a seller who's been kind of hiding in plain sight, a group we don't usually think of as being a major player on the sell side. And here is the smoking gun. The group with the biggest negative beta, the one that's consistently taking the other side of the trade, is the firms themselves. Their beta is a massive negative 0.69. What that means is for every 100 shares an index fund buys, the company itself is effectively selling 69 of those shares by creating them and putting them into the market. And here's the whole picture. It's brilliant. When you combine the firms with short sellers, the only two groups that can actually create new supply in the market, their combined beta is negative 0.94. Together, they accommodate almost the entire demand from index funds. It's nearly a perfect one-for-one match. So the takeaway here is absolutely crucial. The market isn't balancing itself by investors just shuffling existing shares around like a deck of cards. No, it's being balanced by the supply side, literally creating new shares. Firms are the #1 seller by a long shot, followed by short sellers. And meanwhile, the active funds, they're over on the other side, just adding to all the buying pressure. Okay, but that raises a huge question, right? How are companies themselves selling all these shares? And maybe more importantly, why are they doing it? Let's dig into the motive and the method. Now, when you hear firms issuing stock, you probably picture a big, formal stock offering, right? An SEO. But that is not the main story here. Not even close. A wild 80% of this new share supply from firms comes from a completely different place: employee stock compensation. This whole thing creates this powerful but very one-sided mechanism. Here's how it works. Step 1, relentless passive buying pushes stock prices up. Step 2, those higher prices trigger employee stock options or cause their restricted stock units, their RSUs, to vest. Step 3, the employees then sell a lot of these newly issued shares into the market, which neatly satisfies all that passive demand. But, and this is key, notice how it's asymmetric. It only works when prices are going up. There's no reverse gear that forces companies to buy back shares when passive funds start selling. So what's the motive? It's actually completely rational. The paper argues that firms are essentially acting like arbitrageurs in their own stock. This constant price-insensitive demand from index funds drives up valuations. Executives see this and they realize, hey, this is a great time to issue some equity, often through those compensation plans which get way more valuable at higher prices. They are supplying shares exactly when the demand is highest. Now, this isn't just some fascinating, nerdy detail about market plumbing.
This flow of capital from passive investors through companies issuing shares and back to the companies themselves has very real, tangible effects on their balance sheets and on the actual economy.
So check this out. Because firms are using stock for compensation instead of cash, they're saving money. A lot of it. The research shows that for every 1 percentage point increase in passive demand for a stock, that company's cash-to-assets ratio increases by 60 basis points. They are literally piling up cash on their balance sheets.
And with all that extra cash on hand, what do? They get healthier. They pay down debt. That same 1 percentage point increase in passive demand leads to a 70 basis point decrease in the firm's debt-to-assets ratio. It makes them financially stronger and more resilient.
So what happens with all that extra cash? It doesn't just sit in a bank account. The researchers call this a passive dividend. And they show that companies reinvest it. It goes directly into funding future growth, more capital expenditures or CapEx, and more spending on research and development. So in a very real, direct way, your index fund investment is actually helping to fund the next wave of corporate innovation.
All right, so let's bring it all home. What are the big takeaways from all this for you as an investor? How should this change how you think about the market and what's in your own portfolio?
First, the passive boom isn't just shuffling old shares around, it's actively creating new ones. Second, and this is important, this acts as a subtle but constant dilution for you as a shareholder. Your slice of the pie is getting just a little bit smaller over time. Third, it means you should really pay attention to how your companies use stock-based compensation. Fourth, understand this dual effect. Passive flows can prop up valuations, but they also trigger the very share issuance that can put a ceiling on those gains. And finally, remember that any passive premium you think you're getting is in part being paid right back to the companies themselves to fund their own growth.
And before we finish, a huge thank you to NYU grad over at notyouradvisor.com. They're the ones who shared the source material that made this entire explainer possible, and we love it when smart folks point us toward these kinds of hidden gems.
And so we'll leave you with this final thought. This research did a brilliant job solving one mystery. We now know who sells when passive funds buy. But in doing that, it actually uncovered a brand new one. The data shows that when index funds are forced to sell, say during a big market downturn, none of the big players step up to buy. Not active funds, not institutions, not even the firms. The buyer is a mysterious other group of small investors. So the new puzzle is, who are they? Are they the smart money, wisely buying the dip from forced sellers? Or are they the last ones left holding the bag? And that is a puzzle for another day.